Welcome. Today, let's demystify ETFs, one of the most important tools for your financial future. An ETF, or exchange-traded fund, is simply a basket of investments, like a shopping basket filled with different fruits. Instead of buying one stock or bond, you buy a share of the ETF and instantly own a slice of everything inside. Why is this powerful? Because it gives you instant diversification with a single purchase. Imagine wanting to invest in the top 500 US companies. Buying each stock individually would be a nightmare, expensive, and time-consuming. With an ETF, you buy one share and you're invested in all 500 companies at once. This spreads your risk. If one company struggles, others in the basket can balance it out. ETFs make smart, diversified investing accessible to everyone, not just the wealthy. Remember, never put all your eggs in one basket. ETFs help you avoid that mistake. They trade on stock exchanges like regular stocks, so their prices move throughout the day. You can buy or sell them easily, making investing simpler and more affordable. ETFs are designed to help you grow your money while protecting it from unnecessary risk. You don't need a finance degree to use them, just a willingness to start. Think of an ETF as your ticket to building long-term wealth, one basket at a time. That's the beauty of ETFs. So, how is an ETF different from buying a stock? When you buy a stock, you're betting on one company. If it soars, great. If it tanks, you lose. An ETF holds many stocks, sometimes hundreds or thousands, so your risk is spread out. For example, an S&P 500 ETF gives you exposure to Apple, Microsoft, Amazon, and hundreds more, all at once. Mutual funds also offer diversification, but they're only priced once a day and often require higher minimum investments. ETFs trade like stocks, so you can buy or sell them anytime during market hours, often with lower fees. You can start with just one share, sometimes for as little as $50 or $100. This combination of flexibility, low cost, and diversification is why ETFs are so popular. They put the power of investing in your hands, no matter your experience level. ETFs are a game changer for everyday investors. That's why they're revolutionizing how people invest. Let's break down how ETFs work. A fund provider, like Vanguard or BlackRock, creates an ETF by buying a set of assets, such as stocks in a specific index. They bundle these assets and divide them into shares, which are then listed on a stock exchange. You buy ETF shares through your brokerage account, just like you'd buy a stock. The price of an ETF share is set by supply and demand, but it closely tracks the value of the underlying assets. Large institutional investors help keep the ETF's price in line with its actual value through a process called arbitrage. For example, if an ETF holds $100 worth of stocks and issues 10 shares, each share should be worth about $10. When you buy a share, you own a piece of every company in the ETF. As the value of the underlying assets changes, so does your ETF share price. It's a transparent, efficient way to invest in a whole market or sector. There are thousands of ETFs, each with a unique basket of investments. The most common are index ETFs, which track major market indexes like the S&P 500 or Dow Jones. These are passive funds. No one's picking stocks, just mirroring the index. Sector ETFs focus on specific industries like technology or healthcare, letting you invest in a whole sector with one purchase. Bond ETFs hold baskets of bonds, providing steady income and stability, great for balancing risk. Commodity ETFs let you invest in things like gold or oil without owning the physical asset. International ETFs give you exposure to companies outside your home country, like Japan or emerging markets. For most people, starting with a broad market index ETF is the simplest, safest choice. The variety is huge, but you don't need to get fancy. Stick to the basics: broad, low-cost, diversified funds. That's the foundation of a strong portfolio. Choose the type that matches your goals and risk tolerance. The right ETF can help you reach your financial goals faster. Why are ETFs so popular? 3 big reasons. First, low cost. ETFs usually have much lower fees than mutual funds, so more of your money stays invested. Second, easy access. You can buy or sell ETFs anytime the market is open, with just a few clicks. Third, instant diversification. One ETF share can give you exposure to hundreds or thousands of companies. This makes building a diversified portfolio simple and affordable. You don't need a lot of money to get started. Just buy a single share. ETFs have democratized investing, making it accessible to everyone. They're transparent, flexible, and cost-effective. That's why financial experts recommend them for long-term wealth building. ETFs take the complexity out of investing. They're a smart choice for most investors. Let's weigh the pros and cons of ETFs. Pros: diversification, low cost, transparency, flexibility, and accessibility. You can start small and see exactly what you own. But there are downsides. Because ETFs are easy to trade, some people are tempted to buy and sell too often, which can hurt returns. The best results come from buying and holding for the long term. There's also something called tracking error. Sometimes an ETF doesn't perfectly match its index, but this is usually minor. Beware of niche or exotic ETFs. Stick to broad, simple funds. Taxes matter too. You'll owe capital gains if you sell for a profit, and dividends are usually taxable. ETFs are tax-efficient compared to mutual funds, but not tax-free. Overall, the benefits far outweigh the drawbacks for most investors. Just go in with your eyes open and a long-term mindset. Use ETFs as a tool for steady, disciplined investing. That's how you build wealth. Ready to get started? Here's your action plan. First, open a brokerage account with a reputable low-cost firm. This is your gateway to investing. Fund your account. Start with whatever amount you're comfortable with, even $50 or $100. Set up automatic transfers to invest consistently. This is called dollar cost averaging. Choose a broad market index ETF, like one tracking the S&P 500 or total stock market. Look for low fees and strong reputation. Vanguard, iShares, and SPDR are great options. In the UK, look for UCITS ETFs tracking the FTSE 100 or global indices. Place your buy order by searching for the ETF's ticker symbol and choosing how many shares to buy. Congratulations, you're now an investor. The most important step: do nothing. Let your investment grow over time. Keep adding money regularly and resist the urge to sell during market swings. ETFs make it easy to build a secure financial future. Stay disciplined, stay patient, and watch your wealth grow. You've got this.